Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial. We're here to discuss the probability of the Fed cutting rates in September, and the key question is if they should at all. Steve, it's great to see you as always. Welcome back to Trade Talks, and I think that's a really interesting question. Never mind, are they going to lower rates, but is the case there for them to do so?
Well, I think the answer is yes. They are going to cut interest rates. And there's enough weakness in the labor market data. We've talked about this on previous calls where it's clear that the labor market is not as robust as it has been before. Open jobs are down. You can see it in the weekly jobless claims data. While companies aren't firing a lot, and that's important, the continuing claims remain elevated. You can look at stuff like unemployment rate for recent college graduates being pretty high. So it's clear that companies have slowed the hiring process. They just haven't started the firing process. And so I think that I can understand where the Fed is. Look, the reality is they are restrictive at the present time. Their Fed funds target is 4.25 to 4.5. Even when you think about headline or core inflation, it's lower than that, even though the progress towards 2%. And I think this is the question as we look forward, Jill, is the progress towards 2% has slowed. So yes, the Fed is restrictive, but how restrictive are they? And is there a lot of room for them to cut? I 25 basis points, that's no big deal. That gets them to 4 to 4.25. That's not going to be the issue. I think, though, as we look at where the market is pricing in an additional 2 cuts, 3 total this year, and another 3 next year, that's where it becomes a little bit more of a question mark as to just how far the Fed can or should lower rates to get to a neutral rate. And we tend to think it's a little higher than where the market is today.
I think the employment picture is interesting, though, Steve. Perhaps companies aren't hiring right now because they're not sure what types of jobs they need to hire for. And you brought up the point, I think it's like 8.25% is the unemployment rate for recent grads coming out of school. What did we tell kids 4 or 5 years ago? Console, learn how to code, right?
Yeah.
Those jobs are gone in just 4 to 5 years. So I wonder if companies are grappling with who do I hire for? What kind of skill set versus there's an actual issue in the economy or corporate specifically?
Well, I think that's a great point, and this is where the resurgence or the emergence of AI, which might be able to do a lot of these types of jobs that recent college graduates have been taking to kind of get some experience under their belt before they become a real value add to a company. Maybe technology is going to take part of that. But the other part of this, Jill, too, if you break down unemployment by racial statistics, it's really, it's higher for Black Americans. If you look at the U6, the underemployed rate, that's gone up pretty high, too. So I think there are multiple factors. AI, I'm sure, is part of it. And I think the other thing that's keeping companies from firing a lot right now is that as we look through this soft patch in the economy, we start getting into 2026 and 2027 and thinking about some of the potential stimulative benefits of the tax bill extension. Remember that for consumers, while they lowered some taxes, tips over time, and senior income deduction for Social Security recipients, they did not alter the withholding table. So what that's going to mean is that tax refund season next year is going to be a lot bigger than tax refund season was this year. That's a form of stimulus for consumers, but also that's when the big business stuff kicks in. And as we think about the hyperscalers and the amount of money that they're going to be investing in capital expenditures, there's going to be demand in the economy moving forward. And so I think companies are like, they remember how hard it was to hire people during the pandemic. And Jill, one other thing quickly. It's a topic we've talked about, immigration, before. We're seeing an actual shrinking of the labor force. And so these companies know they do not want to be out in the economy competing for a dwindling number of workers going forward. So I think there will be some hesitancy, if you will, on the part of companies to avoid layoffs at levels that might have been more acceptable in years past. Because if we just get through this next 3 or 6 months, next year and the next year look really good.
Yeah, I mean, those are excellent points that you make, but you also noted that the dance between PPI and CPI, those also offer critical insights into the state of the economy, whether they're moving in tandem with each other or if there's a divergence.
Jill, part of this is we all have our biases when we come into and we're looking at economic data that's coming in. And the bias that I've got is I started in the business in January of 1982 as a bond salesman when interest rates were very high. Paul Volcker was the chairman of the Fed, and he was having to hold interest rates very high because we had been through a period in the mid to late 70s where monetary policy was overly accommodative during a period of inflationary pressure. We don't want to see a similar situation occur where when we look at PPI higher than CPI, and I know the way that that kind of feeds into CPI, it's not a one-for-one type of an equation, but as inflation's building in the middle part of the economy, and I'm hearing this from companies that I'm talking to, that their cost of goods, their the raw materials are going up. There's one of two things going to happen. They're going to pass that through to the final consumer. That's a price level problem. Whether that's an inflation problem or not, we can talk about that. But it's a price level problem. If they don't, it's a margin problem for the companies because they're going to be eating those additional costs. Either way, you look at that and go, okay, should the Fed be lowering interest rates when we could be looking at some pretty significant impacts in the core CPI and PCE, if only for a 3 or 6 month period of time? Or should we be really excited about stocks at record highs when we may be looking at some margin pressure as we move through and we kind of get through this impact of the tariffs? It's short term. We tend to believe that it's a price level adjustment, not longer term inflation. But the way you would turn that into an inflation problem is if you try to monetize or you don't remain restrictive in policy as that occurs. And so I think this is where the Fed's really between a rock and a hard place. And we've talked about the data, Jill. That doesn't even include the political side of this with what's going on with the Fed Board of Governors and clear, I mean, even over the weekend with Scott Bessent pretty well writing a pretty critical op-ed on the performance of the Fed over the previous few years. So, man, there's a lot going on for the Fed to consider right now.
I mean, Steve, there's just so much to unpack in that last statement that you just made. I mean, between being caught between a rock and a hard place for corporates, consumers have been through enough with the increase in prices through COVID, and it's a PR nightmare, whether there's pressure from the administration or pressure from consumers. So they're caught between a rock and a hard place as well. And I also, it's not that it's easy, but I guess sitting behind a keyboard, it is easy to doubt the Fed over the past 4 to 5 years. Did they wait too long? Did they move too fast? There really is no precedent or benchmark in terms of what it looks like coming out of a pandemic, the way that the economy is structured now. So
Jill, I think we're all better investors with the value of hindsight. We're all better central bankers with the value of hindsight too. I think it is clear. There's valid criticisms of how long the Fed kept monetary policy as accommodated, zero rates and quantitative easing as we came through that, which the side impact of that was that's why the housing market is such a mess and why rates are part of that.
Right.
And I think this is one of those things. Look, borrowers always want lower interest rates, but we're in an interesting part or an interesting part of the economy where lowering interest rates now, as the Fed lowers interest rates, as a saver, I want higher interest rates. Think about what happened to corporate margins as the Fed raised interest rates aggressively in 2022 and 2023. There was this idea that this was going to increase the debt service cost for a lot of corporations out there. What actually happened? Their interest income went up faster than their debt service costs. Think about consumers. I've got a fixed rate mortgage. The higher rates are not costing me any more money. What will cost me money is if short-term rates continue to fall and what I'm earning on my cash and short-term investments will come down. So in aggregate, U.S. consumers are net savers, not borrowers. So lower interest costs will actually probably reduce national income more than it will help the borrowers. And part of that is I think the average mortgage rate out there is still less than 4%. Let's just say it's 4%.
Mhm.
We're 2% away, 2.5% away from the vast majority of mortgage holders being in the money to be able to refinance. So 25, 50, even 75 basis points, that's going to hurt the income side of the equation more than it's going to help the interest expense side of the equation. So this isn't all, sure, it can help the equity market potentially as long as the Fed's not having to be aggressively easing monetary policy because unemployment has started to move up quickly. Yeah, maybe that can help the wealth effect. That can help that can help the economy overall. But Jill, you know this. You've seen the charts. Aggregate inflation since the start of the pandemic is still above average aggregate wage increases. The offset to that is, man, if you've owned a house, it's up 50%. If you own stocks, they're up 100%. But the bottom 50% of wage earners who don't have many of those financial assets, that's where the squeeze is still on here. And I think this is where, the idea of the Fed maybe backing off on their 2% target, accepting 3%. That doesn't sound like much, the difference between 2 and 3. That's a 50% change in the target. We don't think that's going to happen, but this is where the Fed, I think, it's not politically popular right now. And when you think about the biggest borrower, by the way, Jill, it's not people, it's the federal government. So they clearly want lower interest rates, but I'm not sure that's going to have the type of impact on the economy that might have occurred during some periods in the past.
All right, Steve, appreciate your insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.